following is a presentation of TFNN. It is now time for the Tiger Technician Hour with your host, Basil Chapman. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Basil Chapman.
Hi everyone, Basil Chapman, Tiger Technicians Hour on the 16th day of July, and my pleasure to be here after 3 great hours. You got John Logan, you've got Larry Pesavento, you've got Tom O'Brien. I mean, what more could you want? I try to do my best here at this hour, the 11 o'clock till noon Eastern time frame, and 877-927-6648 is the number to call. The S&P today is way stronger than the Dow. Dow's involved with Goldman Sachs, Home Depot, got a couple of stocks that are acting quite poorly, and that's dragging the Dow so that it is underperforming. The Dow is up 33 at 18,083. The S&P is up 13 at 2120. The comp index is up 48 at 5147. Now, this is going to be very interesting. Gold continues to go lower. It's down $4 at 1143. Why? Because the dollar is up strongly. The dollar is up 39 cents at 97.67. We'll go through the charts in a moment. But in the meantime, back at the ranch, high-grade copper stuck at 253, not that good. Platinum is down 11 at 10.09. Silver's down 5 cents at 14.99. You've got bonds up 10 seconds at 151.05. The TLT's at 117.74, 44 cents. This is really fascinating. I'm just look at this chart right here. This is the chart that I show subscribers every week. This is the triple yield chart. Made the fifth highest peak E in the Chapman Wave weekly chart. The TYX, the 30-year, at 32.55 is pulled back. It's only pulled back a little bit. It's at 31.24, but wow, 31.23. But what's really important, you see this gray horizontal line that I've put in here just to show that we've been in this area so many times over the past many years. This is going to be very interesting because if the yield jumps above 32.56, that'll be more in the pattern that we saw at the end of 2013 where the weekly chart went to an E, F, and G, then pulled back from 39.74. But if the rates are going to be raised, then what we're looking at is a situation that we could have had not an instant restart, but if there's a breakout, that could begin parallel wave F/A. Either it's very negative, meaning that yields are going to go much lower if there's a peak at F, or it's very positive if that turns out to be A. And we'll go into that as time goes on. Meantime, back at the ranch, we're looking at the yields pulling back because the TLT is rallying. That is, bonds rise, yields decline. And now I wanted to show the chart of WOD. This is the Timber Global Timber and Forestry ETF, trading at 53.32 underneath the up channel support. Now that becomes resistance. 54 is going to be resistance. We'll see what happens here, because if at any time in the next 2 weeks it takes out 51, it's like copper. It's saying international construction. It's probably pulling back here. And look at the way the sideways trading range in this rectangle formation of the housing, Philadelphia housing sector index is going right here. Hasn't been able to break 238.32, the most recent high back in, I think it was April of this year in the weekly chart. And look at the low bar. Well, the first real low that will be important will be, it's at 233. If it takes out 222 in the next 2-3 weeks, that's going to be a big negative. There are a couple of other things I want to look at, but in the meantime, back at the ranch, let's just go back to this chart right here. This is the E-mini up 9, having gone all the way to 2115.50. Now, what's really important about the 21, let me get rid of that because that was yesterday, 2115 level, is that I'd say to my subscribers on my opening call, there should be some strong resistance in the 2115 area. Just looking back, but most importantly, you've got this weekly downtrend line, even though it's getting close to the all-time high of 2126. That line comes in at 2118, and that's really the issue. A close above 2119 says, hey, there's no question that you got just an eye blink in which to go to 21.2650 for a new all-time high. And that's going to be important. Talk about all-time highs. The recovery high in the QQQ series going to 111.49 so far today is above the 111.16. Now, what's really important about this is that it starts a bunch of wave counts that suggests that I'm going to a leg D in the weekly chart of the QQQ series. I could give it an alternate count. I don't need to. It's just very clear. Call it D. And the 120-minute chart is in leg F. So what I said to subscribers this morning, the reason why I expect some intraday pullback is that so many charts have gone to E's and F's in the 120-minute time frame that there surely should be some kind of a pullback. Well, we've seen it in the Dow, haven't seen it yet in the S&P, which has been very strong, or the Qs, which has been very strong. So in the meantime, this does a couple of things. The push to a new high today says that the monthly chart is now gone into a leg D after we're calling that now an instant restart from May of 2013. That's how powerful this QQQ series has been. Look, that 9-period moving average hasn't closed below it since, stand by, since July, or is that August? Since September of 2011. Not once has it closed under that black line. It has gone below it just a couple of times and then powered back up. So this is going to be very important. Why? Because July is not finished. Good candle so far. MACD's at 90% good. But the MACD is flattening out, which usually takes on the last up arrow or down arrow. In this case, it's still an up arrow. So that just says that the trend remains in place, the uptrend. But the stochastic at 90% is really what's going to give us a clue as to the shorter term trading. Why? Because the MACD can start to pull back for a while. Look, you saw that right here back in September of 2011 when it went under the 9-period moving average. So you can see that occur, while at the same time, the price can hold up if, in fact, excuse me, if in fact the 9-period moving average of 106 holds as key support. All right. Now I want you to go to the daily, and this is going to be really intriguing. You see this trading band here, like a yo-yo, back and forth between the 111s and 106s, broke once below 105, it went to 105.83. That was back in early July. And now it's gone to a higher high. Essentially what that's doing is what? It's making itself into a single candle. You can consider this candle, we won't talk about it as a weekly candle. Why? Because I prefer to look at this as a single leg A to the upside, going from 105.83 made on the 7th of July, the low of this particular sequence, down sequence, from that former peak D back in mid-June. And then it goes in one leg, it goes all the way to the top. Now, this is a pattern that I've seen many times before. It is unusual in that you don't often break to a new low and then in the same breath go in a single leg A to the upside and break to a new recovery high. This is not an all-time high. That has to go all the way to the 118 level. Let me just double check here. I've got it written down, but I should remember it. There are a couple like this. That's why I'm a little forgetting about 120.03. So that's the level that we'd be looking at, and we're really far from that, but we're on our way. Now, what's really important about this whole sequence is that this could turn into a single leg A if there was sudden bad news and the volatility index, the VIX, which is trading way down at 12.08, I think, 12.26 right now, if that started to move up. But wait a minute. The Fed is not there in terms of having a dark cloud cover, a bad news cover. They've said, we're expecting at some point to raise rates, and the rates have already gone, and we saw that they've gone up. In fact, they're starting to pull down from the big move up. They're having a consolidation, number one. Number two, the Greece fiasco. What could happen from here? They get in the money. We don't know. My suspicion is that if they dig deeper, they'll find out that Greece is way further in the hole than they're talking about. But is that going to really change all that stuff that's gone on? I'm not sure. So what are we looking at here as bad news? What can suddenly produce what I call that dark cloud cover that says every once in a while it's going to flare up as the volatility index rises and make higher and higher lows? Well, the VIX has already gone to the 20s. So let me just get you to the VIX right now. I'm getting back to the QQQ because this leg, single leg A up, has to do a certain bunch of things to confirm that it's going to be going even higher or that it's going to break down. Well, we've got the exact move. No, not quite yet. 1193. If the low today of 1197 breaks 5 cents lower, you will have an engulfing candle, calling it one single move from a high, a recovery high, 20.05 peak F, down to a new low. That is exact opposite of the QQQ series. Now, I should be looking at the, can't remember it offhand, TVX, Vixen. Oh, there it is, VIXN. .x. Oh, I hope it's still notated. I'm getting tired of these. No, not notated. How many times am I supposed to do this? I keep losing it. Every time my computer shuts down and I can't close TradeStation properly, the data's there. It's not that it isn't there, but it's in a different library that is brought up. It is so frustrating. A, B, C, D, E in the Vixen. That is the NDX 100 volatility index. Dark cloud cover, for sure. It's gone into this engulfing candle from a high to a low in one move to the downside. And that says, got to watch this closely, because if there is a sudden rebound for whatever reason, doesn't matter what the reason is, that rebound has to be sharp and it cannot fail. It has to have a move that continues as quickly as it came down, at least to the 50% line, going to the 16.13 or higher 200-period exponential moving average. That's going to be difficult to do. I don't see the bad news right now that's going to give you that. We had it before, and we went down to test the Dow 17,500 level. And look, here's the weekly pulling back sharply. Here's the monthly. Oh, man, I wish I had this all notated. I wonder if I can actually find that chart. Look, it went to peak A, B, C, D. Double check. 23, 28, 23, 30 something, 54, yep. So we've got A, B, C, D, and then an E, and now we're pulling back. So it's going to be very important that the Vixen, that's the QQQ series relationship, opposing relationship, needs to see the 1325 sudden reverse and go up above 1626, really needs to go to 17. What can do that? That's the issue. I'll be right back. Basil Chapman, Target Technicians Hour. I'll be right back talking about my webinar on Monday night. And the Dow's up 27.
If you're looking for a great opportunity to diversify your financial portfolio, consider the Principal Protected Market Safe CD from Everbank. They've just released the second running of their 5-year Market Safe Power Metal CD, which combines the power of gold, silver, and copper. You get exposure to 3 valuable metals in one index CD and have the potential to earn up to 45% capped upside payment at maturity if the metals increase in value across annual pricing dates. And should they decrease? No worries. There's zero risk to your deposited principal here, as you still get 100% of it back. Keep in mind, returns are based on CD performance. There is no annual percentage yield or periodic rate of interest on the CD. Intrigued yet? The August 17th funding deadline is quickly approaching. So hurry over to everbank.com/TFNN-CD for more information, including important product details and disclosures. Once again, that's everbank.com/TFNN-CD. Everbank is a member FDIC.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns as well as market trend calls. years. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN and you'll find the Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
Tiger TV is an exciting way to experience TFNN programming. See high-definition video, giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. Basil takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
So, folks, getting back to the QQQ series, at 78% in the stochastic, and with the MACD giving a wide a wide differential between the 9-period differential right there and the slow-moving average. So far, that is extremely positive, number one. Number two, the MACD is very positive. Stochastic is good, but it needs to be holding in the 80% area and not making an inverted V shape, a U-turn, an arch formation within 2-3 bars, coming back under and going to 68%. That's really my concern in terms of the shorter term. But two things are very important. One is, you see in the weekly chart, look at the way the on-balance volume, that blue line, made a low right there. And where was that low? It was 1 bar before the low of the 18th, the week of the 18th of April at 83.28 in the QQQ series. Nice heads up, a little double bottom, triple bottom actually, and then it soared on the way up. Where was this top right here in the on-balance volume? Right there at peak F/C, which became a peak F. And then we went on to an A, B, C, D. Where was the low for it? Well, the low was at the exact low the week of the 17th of October at 90.24 in the QQQ series. Now we've got a softer type of a reversal, but also at a potential low. This is, in fact, the lowest the on-balance volume has been. The fact that it's at this low says that the rally that occurs, and it's fascinating. Look, you've got the V-shaped bottom in the stochastic and a little bit in the MACD. And in the on-balance volume, it doesn't have the same angle of the rise, which is, say, at about 45% there, maybe a little bit more. Here it's like 20-something percent. So my guess is that you've got a new recovery high in the QQQ series, the weekly chart, while at the same time, you've got the unbalanced volume at a low. So that's suggesting that two things. Number one is that if there is a rally, and that rally, which has gone to a new recovery high, continues into Tuesday of next week, the on-balance volume will be giving you a way better reading, a very good reading, number one. And number two, is there an alternate count that I can use here? Is this an A? Is this maybe a B? Where are we in the alternate count? Well, at this point, I don't have to make an alternate count. It's in leg D. There's nothing wrong with a D. These can turn out to be sharp failure patterns. But as long as it's moving higher and going to the highs of the candle, I have time to think about what's going on. The MACD has not crossed positive at all. Every other time it's failed, and it's been making lower lows and lower highs. It's really not a very good sign. So this is a divergence that I have to take into account. Are the technicals going to follow the price, which is the leader? Or is the price getting away from the technicals? And when it pulls back, it's going to pull back because the technicals fail to confirm. But what's important is that the technicals are in the low ranges or recent low ranges. Is it saying that there could be a pullback, but that pullback could be very minor as the technicals start to improve? So those are three questions that are going to be answered. I don't think it's going to be more than 3 days. Why? Because the day is young. There's a chance that with options expiration, they've managed to squeeze all the puts at this particular point, and later on in the day, they could start to squeeze some of the calls in the options market. And if that's the case, then we've got to see what happens at about 130 to 145 today. If the S&P is holding above where it is now, 13, holding in that area, that should be good. I'm not sure I'm not sure how they're going to be able to drag it down, other than maybe a few points, but not 50% down to a +6 on the S&P. But if that starts to deteriorate between now and 12:45, then you could quite easily see a deeper correction into the rest of the day. But so far, every pullback has been met with nice support. That's a good sign. So the QQQ, these bars creating, in essence, one long bar to the upside, one single leg A, I call it the single leg A up syndrome, says two things. One is, if there is a pullback in the next 2 days, and that makes a peak, whatever it is, E or /A, and then all of a sudden you see an acceleration up, and it takes out that high into what would be leg F/B, you have to consider that to be very important on a short-term basis. Why? Because it reignites the upside, it recycles to the upside, and therefore you can get an even stronger move, and it should take you to about the 112.80 to 113.20 level. I'll be right back. Basil Chapman, Tiger Conditions Hour, Dow's up 30, S&P's up 30.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
TFNN is excited to offer a brand new piece of market scanning software unlike anything the industry has ever seen. John Logan and his team have spent years developing their market profile tools to finally be able to release the TAS Profile Scanner Plus. And right now, you can get a 2-week trial absolutely free just by visiting TFNN.com and providing us your name and email address. The TAS Profile Scanner Scanner Plus is the premier market profile-based scanner in the industry. Powered by the acclaimed TAS proprietary algorithms, this feature-rich scanner is a standalone desktop software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Within 3 minutes of signing up, you can have the software downloaded and running on your computer with a complete roadmap of market indicators and inflection points to trade off using the TAS Profile Scanner Plus. Sign up today and try this amazing piece of software by visiting TFNN.com. Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date, active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters.
You know what's cool? Taking something that's good for you. Something specifically formulated to help with weight loss, better sleep, stress reduction, and the need to detox.
Nico, our hunter and gatherer ancestors found all their nutritional requirements for health in their wild environment. But today, our food sources no longer contain the vitamins, minerals, and nutrients our bodies need to stay healthy and strong.
That's why we need Primal Edge Daily Nutrition. It includes a special blend of ionic, soil-based vitamins, minerals, fatty, and amino acids in an easy-to-use liquid form.
Primal Edge is powered by highly concentrated fulvic and humic acids, nature's preferred delivery system. They have been called miracle molecules because, like sunlight, air, and water, life cannot exist without them.
That's right, Paige. They ensure we receive all the nutrition we need to be healthy and thrive. We take it every morning.
Primal Edge, formulated and approved by Nico and Paige of Living a Primal Lifestyle. Buy it today for just $89. Click on the Primal Edge banner on the front page of TFNN.com. This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Hi, folks. We're back. Dow's up 37. Let me show you the Dow chart. See, what we've been doing for almost all of this year is just trading between the 17,500s and the 18,200s, really 18,100s. And right now, we're in this yellow, let me see if you can see that. Yep, you see that yellow diagonal band that I put in there? This is where we are. See the doji from yesterday, doji from today in the Dow. This is going to be a very important moment. Why? Because dojis can sometimes be halfway markers, and that says that if there's even a little bit of a pullback, but you break into the 18,100s, you have to consider, with the stochastic now at 80% and the MACD expanding, that there is a chance to go to the upper band. I can even start, I won't do it now, but you could raise that band right to that area there, the 18,200 to 18,350s into that area. And that's going to be very important, regardless of whether there are some stocks in the Dow that are not participating, not acting all that well. But if there is a options-related sell or whatever it is that takes the Dow lower, and the Dow starts to go back into the 17,920 to 17,870 area, that says, hold on, this is just nothing more than a bounce. You're going to need a little more proof to be able to go higher. This is the Dow. Now let's go on to the different indexes. Why? Because they're acting differently. And what's fascinating about markets is that bottoms are sometimes coincidental, as in March of 2009. That was March the 6th for the Dow, March the 9th for the S&P. Now, what's really important about that is that the bad news accelerates to the point of such magnitude that you get this climactic sell-off and reversal. Well, on the upside, you don't get those things to the upside going in a coincident way. So sometimes you can get like the Qs at a new high, but you can get the New York Stock Exchange, NYA.X, down here, just stuck in this level. It can't get out of its own way at this particular point. See these downtrend lines? Well, by Tuesday, maybe it has. Maybe it's got out of its way because instead of being up 67 at 11,026, it is pushing into the 11,080s and breaking all the, no, it should be a little higher. Let's say 11,100s. And that would say, you know what? I've finally broken all that resistance. I'm going to at least attempt to go higher and try to make that leg D in this move now rather than later in the monthly chart to an all-time high of 11,255 above the previous high. That would be that peak D that was made back in May, was it? Yeah, May the week of the 22nd. So we're going to be watching this real closely. Now, the next thing is the SMHs. SMHs is the semiconductor index, which we were short, got fabulous, absolutely fabulous gains there. And we are still short a small position from way back. It's via the 200% short ETF. So we shorted way back on the around about the 25th of June, up at a comparable price of about 57 something in the SMHs, and now it's down at 53.29. So this says to me that some sectors are starting to break down, but this is a sector that should technically be affecting a little bit the QQQ series, but it's not. Why? Because you've got a couple of leaders in the Nasdaq, in the Index 100, in the QQQs, like a Netflix, which broke to an all-time high today. Leg D gap up in the daily at 114.08, up 15.93, up 16%. That is huge. Leg F I've got in the weekly chart, and leg G/B in the G-A-B, should be G/C in the monthly chart. Looking absolutely fantastic as it stands right now. And what is it saying? It's saying that selectivity, spoken about this for ages, significant selectivity has been the name of this rotational correction that's been going on for a year. It's a sideways rotation of different sectors and different stocks. So this is something that's very important. And if I look at Amazon, we'll go to our first caller right now. Amazon also just about trying to break to a new recovery high, all-time high, in fact, at 468.76. Jerry in the Back Bay. Jerry, how are you?
Hi, all right, how are you?
I'm very well, thank you. Congratulations, you had a fabulous call. You've been short crude oil, and the USO right now is trading at 17.23, and it's down. It's about unchanged, but it's down sharply from the 21s when we were looking at it a couple of weeks ago, quite a few weeks ago.
Yeah, I shorted it at 1990 about 3 months ago. Yeah.
Good.
What I'm interested in now is I think it's going to have another leg down. It's the peak use season. Demand goes down in August, September, and October, and the production is not going down and going to have more build. But I'm wondering about another entry point for adding to the short.
Okay, so there are two things going on here. One is that you've got the Iran deal, which you had spoken about. It's not having that bigger effect. I think it was the anticipation of it. And now you've got an H pattern in the daily chart, also the 120-minute chart. Actually, in all the charts, you've got an H pattern, lowercase h. What's really important about this is that the low that was made at 16.95 on the 7th, let's see here, right there, and trough E in the daily chart, that's going to be very important. Why? Because if it's taken out and cannot bounce back to, okay, let me give you numbers. 1680 is the level that you're going to be watching on the longer term. That's the weekly chart. The daily has 1695. I'm going to go with the 1695 first. If, in fact, it pulls back and it closes under 1695 and within 2 days is not able to break above 1695, that's going to say that it is on its way now rather than after a little bit of a bounce on its way to the 15, what did I say? It was 68 level, 15, 61 level. and that's the low back in May. Now, this is going to be very important. To add to a position, you've got two choices. One is to start a little nibble right here, saying, you know what, if it takes out that low and it keeps going down, there's just no way that it's going to have the strength to get back to at least the 9-period moving average of 1776. That's one way. So you start a little position, and you could even add to it if after the second day, if it breaks that low down, that low of 1695, if on the second session it's still way under, it hasn't closed above there, then you could maybe add to that position. But that's a little bit more aggressive. The other way is you just wait for the H pattern to unfold and turn into a lowercase m. That m should take it to between 1777, maybe even 1814, without filling the gap with a low of 1758. That's going to be very important. 1758. Wait a minute. That's of 1833. The gap high of the 6th of July is 1833. I don't think it's going to have the strength to get there now, unless something really special happens in the way of.
You need an event for that. Yeah.
You got to have something, and in fact, with the dollar, let me just look at the dollar, because there is a relationship there besides just the pure relationship of crude oil to the excessive the building of inventory. The way I'm looking at it, that dollar's still acting very well. I don't see the dollar doing much now that it's broken out. Oh, has it broken that high of 97.78? The high now is 97.76. It needs 3 cents to break above that previous left side high bar. So, all right, let's just be very pragmatic about this. I know that your objective is to see quite a lot lower oil. Is that correct?
Yeah, about 15. The old low. The old low.
Okay, so if that's the case, then we also get to crude oil. We don't want to be doing things in isolation. Yep, crude oil confirms that pattern as well. So here are the two things that you could do. You could add another small position now, saying if I add it with crude oil trading in the continuous contract, I've got it at 51.52. I'm using that just now because that's the benchmark I want to use.
Yeah, I understand.
There is a chance that it could pop. I don't know what will do it, but it could pop between 50 to 52.90 to 53.80, maybe 54.09, but somewhere in that area, and then it should start heading back down again. So if you're prepared to have a 2 to a 3 point, which would be about a 7% risk on adding a small position right now, I would say if you're adding a small position, you've got to have a wider risk because you want to add back. If there is a rally, you want to add more as it gets to the 50, let's say 53 to be safe. Around about 53, you want to be adding because that's where it should start to move back down. So that's the one way. Or you can just say, hey, I'm in a nice position. I'd rather wait for the rally to add, to give myself, I don't need any risk. I want as little risk as possible. So a bounce up, a bounce of 1.5, 2 points, I'm ready to start adding to my short position. So there are two ways. Either you add a little bit right now, and then you can add more later, or you just have patience and you wait for if there's going to be a lowercase m formation, another arch to unfold, that will unfold, and it'll try to get to the 9-period moving average, not in the weekly, which is up at 56.47, but the daily, which is at 53. My thinking is if it goes to 53, it could go just a little bit higher. That's the area that you want to add to your short. Now, I would be wrong if I don't know what will do it, but if for any reason crude oil is going to have a very strong rally to make another big weekly lowercase m pattern going to the from 51.50 all the way to the 61, 62 area, we'll know because the dollar, I suspect, will have to be coming down sharply. And that would say that the dollar at 97.57 right now, the index, it will have broken under 96. It'll be starting to close under 96, and then you'll see your spike in crude. I just don't see that right now.
Yeah. All right. Thank you.
I think you're right, and that's the only way I would look at it. A little bit now, add to it, or just hold on, have patience.
Thanks a lot. Yeah, those are good parameters.
Good. Thank you so much. Thank you for calling, Jerry.
Bye.
Bye-bye. So, okay, folks, now we've spoken about the dollar. Look at the euro, EUR/USD. The euro pulling back at a lowercase d, making the arch formation, that very pattern I was talking about, the arch formation in the weekly chart. Now, I'm going to be looking at these in my overview. You can go to the front page of TFNN and you'll see in that overview what it says right here. Let me go to TFNN. It says Basil Chapman follows up on his popular 1920s webinars. Join Basil Chapman for an hour-long webinar where he follows up on his 2 previous webinars showing the matches between the 1920s and today. So I'm going to be talking about what we're looking at sociologically, economically, politically, a whole bunch of things. Also going to be introducing a couple of new aspects. But at the same time, what is really important as far as I'm concerned is that I expect, I don't know if it's going to happen in this phase without going down. So that's what I'm going to have to talk about. And what's nice is that by Monday, I'll have a tremendous amount more of information because we'll see whether the S&P, let me go to the S&P to show you what I'm talking about, whether this is a move right now, that is starting a breakout to the next move in the Dow without having that requisite, which I thought we've had we can call it even an 8 or 9 month consolidation. And if you're going through that consolidation, let's just do this here. Look at the weekly charts, and not so much in the weekly chart of the S&P. That's only been in from, let's call it from about here, from February. But if you go to the Dow has been in a way longer one. That's going back all the way to, you could even think that it went back to the November-December period. We've been in this consolidation, and we know that rectangle formations can go on a lot longer than your patience, at least my patience. And what's really important about this, I've drawn the semicircle potential right here. We went to the target that I had in the weekly chart. I suppose if I was absolutely strict about my parameters, and I should have been, I should have said, you know what? The best thing is go long the Dow at 17,500 with like the diamonds with a 1 point stop or 1.5 point stop, because if it's going to fail, it's going to fail miserably. We're going to go much lower, and a close 2 out of 3 sessions below 17,500 would set off alarm bells about the weekly chart. But if it holds, then that weekly, very long-term up channel, which you've seen in the Dow and the S&P, and the target that I had been met, and that there could be a very strong bounce. Did I expect that the bounce would be a bounce that takes you to a new all-time high above 18,351? No, I didn't expect that now, because I was considering that this rotational correction would be still ongoing. But if, in fact, you start to see a little breakout here, a little breakout there, I have to have respect for that. Look, the IWM has not broken out. It's way below the 129.10 level. The New York Stock Exchange, NYA.X, is still, I would say, it's great action, but it's still way below its all-time high. And I was speaking to you about the rotational tops rather than the magnanimous universal V-shaped bottoms that you make. Tops can unfold in rotation. I'll be back.
You take a hands-on approach to managing your investments, and whether you're bullish or bearish on U.S. Treasuries, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at directionshares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC.
Hi, I'm I'm Steve Rhodes, host of the Trader's Edge, heard daily at TFNN.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of TFNN.com.
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Up next, the Diagnostics Trading Hour with Daryl Martin here on TFNN.
Folks, we got a full house Thursday. You go right through. You got John, you had Larry, you had Tom, you got me. And straight off this, you got Daryl, you've got Steve Rhodes, you've got Dave White, you've got Tom O'Brien, you've got Andy Hecht. I mean, a full house today. Should be a great day for this. So the IYCs, the iShares U.S. Consumer Services ETF, all-time high, leg E in the monthly. This is the chap wave stalk leg formation. You remember I drew this in the other day, leg, body, neck, and then you should get the head and the beak where you start to come down the weekly. That's not telling you when, it's just telling you the pattern to look for. But leg D in the daily right now, but the stochastics at 93%, the MACD is good. So this is still acting very well. There are some sectors looking very, very good. Look, the SMH is the exact opposite. Coming down to the bottom, this one you're going back to the top. IWM, same thing. And you've got the one that I'm missing that I wanted to do was, oh, that's right. We were looking at it the other day. And if you're looking at the IBB, the IBB has got a nice little bounce from yesterday, but yesterday's 396.94. That's going to be very interesting because you made a peak F in the 120-minute chart. Now, this has been the one area that's been able to save fund managers every single time the market has given even an eye blink of a pullback. If you bought the IBB, you were saved. So we've been watching this real closely. But I wanted to just talk about the XLF right now. The XLF is the daily chart. Looking at the daily chart, it's broken out. It's got that same single leg A up. Is this an E or is it an E/A? Leg E in the weekly chart, E in the monthly. this is a G/C in the 120. There, I drew this pattern. We missed buying the darn thing. Yeah, my fault. I should have just grabbed it. Had the pattern already. Look, it's done. It's met every single one of the criteria, except it broke out in one bar early to the upside above 25.31. So once you've got a sector that's being a laggard starting to move, it means that you've got some leadership. So right now, Goldman Sachs is acting poorly, but certainly the XLF is acting very well, breaking to a recovery high. That's going to be very important. So you've got a rotational aspect to this market. Certain stocks and certain sectors are very weak, and others are leading. And actually, the leaders are really leading. So that's important. So what I'm going to be talking about on Monday night, and it's only open to subscribers, but you can get a free subscription and come to the webinar. That's going to be, for me, it's a very important one because I had time cycles that were moving along. But most importantly, if you're looking at, let's just take this chart here before we wrap up. If you look at this S&P weekly chart, monthly chart, look at the up channel and look where we are. We've rotated, and there's a chance that maybe you have to get to a leg D in the first week of August, let's say, if it can't do it now. And that'll take you to a D. But at the same time, you're up in the area of resistance that's always been a repellent zone. I call it the Chapman wave repellent sell zone. And whenever the price has been here, it's turned around and has pulled back sharply. So this cluster pattern here is going to be very important. We've seen them before in the same pattern. I don't expect, in any case, whatever the monthly chart is, I don't expect that the decline that that I had been anticipating, which might have been usurped by going sideways, I had anticipated that would start your leg 4 down in the Elliott wave. It's still a possibility. I don't know what the bad news will be to get it to you there, to start breaking down, to go into the 2000 or 1900 area in the S&P. But most importantly, what we are looking at is that, as my work says, and this it relates to the parallels between the late 1920s and now, there are so many things that are starting to match that my suspicion is that we will go into 2016, and that's going to be the critical year. So looking out, even if we have a sharp decline, I still see higher prices somehow or other. And that's my outlook, and that's what I'll be talking about when we get together on Monday evening. Check it out, front page of TFNN. Hey, stay tuned. You've got Daryl coming up. Great show as always, and I will be back.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
This is TFNN,